Hello, everyone. A very good evening to each one of you. Welcome to What It Takes to Manage Your Money. This is an event in the What It Takes series organized by the Alumni Relations team, featuring alumni speaking to current students and recent graduates. My name is Taruna, and I am the Vice President of Welfare here at the Students' Union of our university, and I will be your host today. Great. I think everybody has joined now. Thank you so much for your time and a very warm welcome once again. Before I introduce our speaker, there are a few things which I would like to bring to your notice. This talk is being recorded and it will be edited and made available on the Alumni YouTube channel within the next few weeks. Your cameras and microphones are automatically turned off. The group chat is there for you to ask your questions to our speaker. We'll collate our questions during the talk and I'll put these to today's speaker. This recording of the event, which ends up on YouTube, won't pick up any of your usernames or the chat. And please bear with us if we experience any technical issues during this evening's event. I am delighted to introduce our alumni speaker today, and she is Rebecca Fearnley, who will be sharing her thoughts and insights on what it takes to manage your money. A very warm welcome, Rebecca, and thank you so much for joining us today. Rebecca Fearnley is a consumer advocate, researcher, and journalist. She graduated from Westminster with an MA in journalism studies in 1996. She has extensive knowledge of and insight into consumer issues, having spent more than 2 decades working for the consumer organization Which, until leaving in July 2022. She's about to start work as a pensions proposition manager at the Money and Pension Service. Rebecca will do her talk first, and then I'll put all of your questions to her. And meanwhile, if you have anything, please put it in the group chat. Uh, a very warm welcome, Rebecca, and the floor is all yours now.
Thank you very much, Taruna, and welcome everybody. Right, I'll just put my slides up. Just bear with me, and then we can get going. Right, hopefully everybody can see that.
Yes.
Please say if you can't. Right, so welcome to What It Takes to Manage Your Money. I'm going to talk you through some basic kind of principles of budgeting and managing your money. Hopefully I'm not going to be telling you too much that you already know, and you'll get some kind of useful tips and hints throughout the talk. Taruna's covered quite a lot of this, but I just thought I would start off by introducing myself in a little bit more depth so you know who it is that's talking to you and why I feel that I've got any qualification to be telling you what I am. So as Taruna mentioned, I did MA in journalism studies back in the mid-1990s. And then I spent 22 years working at Which, the consumer organisation. Initially, I worked as a personal finance journalist, so I was writing articles for the main Which magazine and their Which Money magazine, anything from kind of market analysis, looking at the best savings accounts, to in-depth investigations into markets where we knew there was consumer detriment, misleading financial advice, anything like that really. Following on that, from that, I spent about 8 years managing the Which Money helpline, which was a helpline which offered, and still does offer, money help and guidance to Which members on really any money subject. So anything from wanting to know what the best savings account is, to managing your pension, to help if you've been a victim of a scam. It really covers the whole kind of range of personal finance subjects. And then I spent the last few years managing all of the kind of insight from consumers that our advice services teams were getting, and making sure that Which, as a consumer organisation, understood what consumers were telling us about the issues that were impacting them, and that they were using that to inform their kind of policy and content work. And during that time, I also led on Which's scams work, which identified several areas of consumer detriment, which it wanted to really focus its attentions on, and one of those was scams. And I led that and brought various teams together from across the organisation to try and make sure that Which was really tackling the harm which we know that scams cause to consumers. And then, as Taruna says, I left Which in July, and I'm about to join the Money and Pension Service, very much going back to one of my areas of expertise, which is pensions. and looking at the guidance they're going to be giving to consumers around pensions dashboards, which will put people's pensions in one place and allow them to see everything they've got in one place. And I start that in a couple of weeks. So moving on to what we actually want to talk about today, I thought I'd start off by setting the scene a bit, just talking about things that are impacting how we're all having to manage our money. I think most of us are feeling like we need to tighten our belts a bit at the moment. We're in the middle of one of the biggest cost of living crises in living memory, really. What's driving this? Well, high inflation. Inflation is at record levels. It was 11.1% in October, which is the highest we've seen in more than 40 years. This is driven by and affects high prices in the shops. It's costing us more to run our cars, and it's costing us more to heat our homes. Gas prices increased by a whopping 96% and electricity by 54% in the 12 months to August this year. And I think we're all feeling that in our rising bills. Other things that are likely to affect particularly younger people like yourselves, I think, starting out on your kind of financial journey, there's been a 13.5% increase in the average price of a first-time buyer house in the year to August 2022. So it's going to be a bit harder for people to get on the property ladder. They're going to need to save up a bigger deposit, and potentially it will take a bit longer for them to get there. And credit card debt, and actually just personal debt, is on the increase. And this is a good sign, well, not a good sign, but it's a sign that people are struggling. So credit card debt has risen to more than 2,200 per household in August 2022, and total personal debt in the UK went up by more than £70 billion to 1.816 billion at the end of August. So that sort of rising levels of debt is an indication that people are struggling. They may be turning to debt more to cover the cost of essentials, and they're struggling to repay what it is they're borrowing. And I think we've all probably seen in the news that there's been a big rise in the use of food banks, indicating the difficulties people are having, even doing the basic things, being able to pay for food to put on the table. So in the context of this cost of living crisis, I think all of us are trying to think about how we can make the most of our money. So over the next few slides, I'm going to take you through some basic stuff and some sort of tips and some basic understanding of financial products and how you can make some savings across some of the products that we all kind of use and pay for in our everyday. So starting off with, I guess, what I've called the basics and getting the basics right. I think getting into good spending and savings habits early on is really, really important, because these will set the foundations for kind of good habits as you go throughout your lives, and your financial needs and objectives and priorities change. So the first thing I would say that it makes sense to do is to do a budget. Just literally make a note, take a look, set out what money you have coming in and what money you have going out each month. You can do this very easily on an Excel spreadsheet, but there are also lots of tools out there to help you. The one that I've put up here is offered by the Money and Pension Service. It's called Money Helper, www.moneyhelper.org.uk. And I would say don't feel you have to note down all the website addresses and things, because we can circulate these slides after the talk. The budget planner will save all your details. It will give you hints and tips, allows you to set goals, I think. So it's quite a useful little tool, but there are lots of other ones out there on the internet. So you've done your budget, you've put down what's coming in and what's going out. And there's one of two really potential outcomes. Outcome one, you're spending more than you're earning. This is obviously not good. Or outcome two, happy days, your income exceeds your outgoings and you've got a bit of a surplus each month. Obviously, in the first one of these scenarios, you definitely need to take a close look at your spending and understand where your money's going, and really try and identify where you can make some savings to try and bring the outgoings down to within your income levels. But I would say that even if your income exceeds your outgoings, taking a look at your expenditure and really understanding what it is you're spending your money on is a really good first step to managing your budget and to understanding where you can make savings and maybe have a bit more money to put aside for a rainy day or to spend on the things you really enjoy doing. And I think there's two sides to this, really. There's the side of kind of managing, doing an audit of your regular payments and understanding your spending, and then looking at the things that you're spending your money on, the bills we all have to pay, our insurance, our utilities, and understanding where you can make really some quite big savings on those. And I'll take you through that in a little while. But I would say as a first step, take a look at your expenditure. And a really good idea is to audit your regular payments. Take a look at your direct debits and standing orders. Are there any you can cut out? Are you still paying for that gym that you haven't visited in the last 6 months? Do you really need to be paying for 3 or 4 streaming services? Could you manage with 1 or 2? Are there any other direct debits, potentially you'd forgotten even that were going out? So take a look and really understand. Potentially be a little bit brutal. Not saying we'll have to live like monks, but just understand what you're spending your money on, and be honest with yourself about whether there are things that you could cut out, particularly if it's outcome one and you have less income than you're spending. So I would say that's a really good step, and it's fairly straightforward to do, and it will really, going through that process will really give you a good sense of where your money is going and what you're spending it on. And once you've done that, it's time to take a look at your finances and potentially give them a bit of a spring clean. Where can you make some savings in some of the things that we're spending money on regularly, like insurance and utilities? And so over the next few slides, I'll take you through some of the kind of basic, I guess, financial products that you might want to use in your everyday life, and where you might be able to make some savings, and how to make good choices, I guess, about what products you take out. So I don't know why this slide isn't loading. Sorry, bear with me. Sorry, it's glitching. Well, I'll start talking. There we go. So borrowing and debt. Ideally, in an ideal world, none of us would have any debt. But I'm conscious I'm speaking to a group of students and recent graduates, so there's a good chance that you are all carrying quite a lot of debt, possibly in addition to your student loans. So I think it's important to understand the different options for borrowing, and where some are good for some things and some are good for other things. And I guess the important thing to say is, if you are going to borrow, not to overcommit, and to make sure that you can afford the repayments. So I'll just talk through some of the main ways of borrowing. So the first one on here is authorised fee-free overdrafts, which come with your current account. So most current accounts offer, or a lot of current accounts offer, £100 or £200 where interest and fee-free, so you're not paying anything to borrow from the bank. These are good for borrowing smaller amounts, or if you just find that you haven't quite got enough to tide you over to the end of the month, so for dipping into. But just do beware unauthorised fees. If you think you're going to go into an unauthorised overdraft, either because you don't have any overdraft arranged at all, or you're going to go over your limit, do speak to your bank and see if they can help you out. Because if you go into an unauthorised overdraft, it will cost you. There will be fees and high interest to pay. And so it makes sense to talk to your bank before that happens, and see if they can give you a small buffer, or really help you not go. It's not in your interest or in theirs for you to go into unauthorised overdraft and start getting into a bit of a spiral of expensive fees and interest. Credit cards, ideally to be avoided. They're quite an expensive way to borrow. The interest rates tend to be up in the high teens, so 18, 19, 20%. But they can be good for some things. If you feel if you want to make a big purchase, they can be a good way of spreading the payments on that. But in that instance, I would suggest looking for 0% deals. There are cards that will only charge 0% on purchases. So if you're looking to make a big purchase, that makes sense, but only if you're sure you're going to be able to pay the balance off before the end of the 0% deal. They usually last for, say, 18 months or a year, 2 years. And there are also 0% balance transfer cards. If you take out a 0% purchase or balance transfer card, really only use it for the thing you took it out for. Don't spend on a 0% balance transfer card, because you will pay interest on it. Keep separate cards for separate things. And if you are paying interest on a credit card, just watch out for the minimum repayment trap. If you only pay the minimum repayment every month, it will take you, obviously depending on the size of the debt, but potentially a very long time to repay it, because it's set at a very low level. If we think back to the figure I showed you on an earlier slide about the average UK credit card debt, the minimum repayment on that in the first month would be £60. And obviously if you pay the minimum, that will reduce slightly every month. If you only pay the minimum every month, it would take you over 25 years to repay that debt. If, however, you paid £60 in the first month and kept the repayment at £60 each month, it would take you 20 years less. It would take you around 5 years to repay it. So the minimum repayment is generally set at a very low level, and it really, if possible, I mean, obviously pay the minimum if that's all you can repay, but if you can possibly pay more, you will pay it off very much quicker. Credit cards have a very distinctive advantage. If you do need to buy something, you get an excellent piece of consumer protection that some people may know of, some people won't. It's called Section 75 of the Consumer Credit Act, and it means that the credit card provider is jointly liable with the retailer if anything goes wrong. So if you buy something and the person you've bought it off goes out of business, or if there's a problem with it and they won't refund you, if the item costs between £100 and £30,000, then you can go to your credit card provider and ask them to reimburse you. So it's a really useful and important piece of consumer protection. For me, if I'm going to make a big purchase, even if I have the money there to make it, I'll buy the product on the credit card and then I'll repay the credit card, because then I get the Section 75 protection if anything goes wrong. So if I'm buying a holiday, say, I'll always at least put the deposit on a credit card, because even if you just pay the deposit, you get coverage for the whole holiday. So that's a bit of protection a bit of consumer protection it's worth knowing about. And credit cards can be very useful for building your credit score. So you need a good credit score if you want to borrow, if you want to take out a mobile phone contract. Anyone lending to you will take a look at your credit report and assess how much borrowing you've got, how good you are at repaying. And there are specific credit cards, they have quite high interest rates, which are there specifically to help you build your credit score. You do need to make sure you make a repayment every month. Ideally, you'll pay it off in full each month. But it makes sense to set up a direct debit just to make sure that you are paying at least the minimum and you won't incur late payment fees, because a late payment will go on your credit score and make it harder for you to get credit in future. And just lastly, on credit cards, some of them offer rewards. Cashback's quite a common one. Sometimes they give you rewards if you spend in certain shops. They can be worth doing, but really only if you pay your credit card in full each month. There's no point in getting 2% on the money you spend, only to be paying 18, 19, 20% on what you've borrowed. So just to bear in mind, if you go for a reward credit card for the cashback or something, do pay the balance in full each month. So that's overdrafts and credit cards. Just a couple of other ways of borrowing. Loans, they tend to be good for borrowing larger amounts. They're usually over a fixed term, usually over a slightly longer term, a year plus. And at the outset, you'll know how much you're borrowing, how long it will take you to repay it, and how much you'll be paying each month. So they're quite good for planning. As long as you're sure you can make the repayments, they're quite a good way of borrowing. If you're looking to make a particular purchase, for example, tend to get lower interest rates than on credit cards or on overdrafts once you go beyond the interest-free bit of it. But just be aware of early repayment penalties. If you want to repay it early, some of the loans will have a penalty. Not all of them, but some do. And then I just wanted to touch on buy now, pay later. You've probably all seen these when you're shopping, particularly online. So this is companies like Klarna and ClearPay and Lay-Buy. They offer short-term credit, so the attractiveness is that you buy your item and you don't have to pay it back maybe for 3 months, 4 months. You either pay it in instalments or at a fixed point, and as long as you pay it off as arranged in the instalments or at the fixed point, you won't pay any interest on what you've borrowed, which is great as long as you remember to repay it. Slight concern with buy now, pay later, certainly for consumer organisations like Which, is that it's unregulated. So all the other types of credit I've talked about are regulated by the Financial Conduct Authority, which means that if something goes wrong, you've got some protection there. But buy now, pay later isn't regulated, so there's very few protections for you there if something goes wrong. And they also don't do affordability checks like any other lender would do. They won't check your credit file, they won't check what else you've got borrowed. So there is a risk that you take on more debt that you can afford. So just to be aware, they can be useful, but just don't overcommit, I suppose would be the tip there. And to be aware that you don't have any protection if anything goes wrong. So just also wanted to talk very briefly about when managed debt becomes problem debt. As I say, ideally none of us would go into debt, but sometimes it's quite useful to borrow, and that's fine as long as you can afford it. A sign that it's becoming problem debt would be if you're struggling to make monthly repayments, or if you're using credit cards or loans to cover the gap between what you're earning and what you're spending. So if you're using the credit card at the end of every month and they're not really managing to pay it back, that's a sign that your debt might be becoming problematic. If you are struggling to pay bills, there are priority bills that you should, as the name suggests, prioritise. Always try and cover rent, utilities and council tax. You don't want to end up homeless, and you don't want to end up without heating and light. And if you don't pay your council tax, they will probably take you to court quite readily. So if you're struggling, they're the ones to prioritise. If you do have any savings, it always makes sense to pay your debt off first. You won't be earning interest on your savings that's anything like as high as the interest you're paying on your debt. So financially, it just doesn't make sense. Even if you can't pay the debt off entirely, if you can pay it down a bit, you will pay less interest, and therefore your monthly repayments will get less. Depending on the size of the amount you owe, consider a 0% credit card, but really think about that and only do it if you know you can afford the repayments, and because you don't want to end up making the situation worse. And if you are struggling, there is a lot of free debt advice out there. There are also companies that charge. To me, it doesn't seem to make sense to pay for debt advice when you're already struggling with your money, especially when there's very good free advice out there. So Citizens Advice offers free debt advice. There's a very good organisation called Step Change, National Debt Line. There are others that offer free advice as well, but these are just 3 that I know of that are very good. So if you are struggling, they will be able to help. Please do reach out to them. So we've talked a little bit about debt. What if you've got money left over at the end of every month, and you want to start saving? So I'll just take you through a few different types of saving account and a few things to know if you are saving or wanting to save some money. So the first thing to say, a kind of fundamental kind of rule of financial planning really, is if you can afford to save some money, aim to build up an emergency savings pot that is roughly equivalent to 3 months of your salary. That's something to aim for. That just means that you've got a buffer there if anything goes wrong. If you find yourself suddenly out of work, then you have a bit of money there to tide you over until you find a job. You also have a pot to dip into if you suddenly need to replace the boiler, need a new washing machine. You've got a pot of money there and you don't then need to borrow. Interest on savings accounts is taxable income, so potentially you can be taxed on it. However, everybody has a personal savings allowance, which means that if you're a basic rates taxpayer is £1,000. If you're a higher rate taxpayer, it's £500. And what it means is effectively that although in theory savings interest is taxable, effectively most savings accounts are tax-free. At current rates of interest, you'd need more than £40,000 in a top-paying savings account to exceed the personal savings allowance. So paying tax on the interest probably isn't something most of us need to worry about. There are different types of savings accounts. So if you need quick access to your money, go for an easy access account. But do watch out. Some of them have limited withdrawals. So if you think you're going to be dipping in and out of your savings, go for one that doesn't put limits on that. Worth noting as well that there are quite a few current accounts out there that will pay interest on credit balances. And look out for bonus rates. Savings providers will lure you in with attractively high rates, but often that will include a bonus that will expire after 6 months. Not a problem, but just to be aware of and make a note of it. And when your bonus rate expires, do shop around. It's quite a competitive market out there, and there will be people looking to get your custom. If you can afford to lock your cash away for a period of time, you'll get a bigger return on your money. So fixed rate accounts will tie up your money for 1 year, 2 years, 3 years, and the longer you tie up for, the higher the interest rate you get, but you can't get at your cash during that time. So they're worth thinking about if you know you're not going to need it. In an environment like we have at the moment, where interest rates are going up, it's worth thinking about how long you tie your money up for. There's a risk that if you tie it up for 3 years, the interest rate is very attractive now, but by the time you get to the end of that 3 years, you'll miss out on any rising rates. It's a difficult one to call, but it's just one to think about, particularly in an environment where interest rates are going up. And if you want to save a smaller amount each month rather than a lump sum, then regular savings accounts are worth looking at. They offer very attractive rates, which will look a lot higher than the rates on other types of savings accounts. But there are limits to how much you can save, usually maybe £200 or £300 a month. And you only get that headline rate on an increasing balance. So you won't earn as much as you would with the same rate on a lump sum. So don't try and compare the interest rates on a regular savings account with one on, say, on an easy access account, because you'll be comparing apples and pears. They're really not the same. And there are also tax-free savings accounts called individual savings accounts, or ISAs. These, you can save up to £20,000 a year in these, but do compare rates across the market if you're going to go for one with other types of savings account, because unless you have used up your personal savings allowance, then there's no particular advantage to taking out an ISA. But if you do have an ISA and you do want to switch it, just be aware you can't move the money yourself. You have to talk to your provider. If you move it yourself, it loses its tax-free status. So just want to be aware of. And on this side, I just talk about a couple of government-backed savings schemes which might be of interest and are worth knowing about. So Help to Save is for people who are on certain benefits, so universal credit or tax credits, and the government will give a 50% bonus on any amount saved, up to a total bonus of £1,200 over 4 years. So it's quite a nice boost on your savings. They're instant access accounts, so you can get out the money if you need it. So that's worth bearing in mind if you're eligible. And the lifetime ISA is aimed at first-time buyers. And again, the government will boost your savings. They'll give you 25% on top of anything you save, up to £4,000 a year. So if you put in £1,000, you'll actually get £1,250. There are some criteria. You have to be aged 18 to 39, and you have to use the money for a deposit on a first house, which can cost up to £440,000. And you can only do that once you've had the lifetime ISA for 12 months. And if you do use it for anything other than a first home, there is usually a 25% withdrawal penalty. So there are some fairly strict criteria, but if you are saving for a deposit for a house, then it's kind of a bit of a no-brainer, because you'll get 25% off the government in addition to what you save. And then I just thought I'd mention premium bonds. These are also tax-free. They're backed by the government, run by National Savings and Investment. On premium bonds, you get prizes and not interest. So you put your money in and you get periodic prizes. You can't predict how many prizes you'll get, but based on the chances of your average chance of winning a prize, National Savings and Investment currently saying the average return is 2.2%. So it's not record beating, but it's also not bad. And because it's backed by government, your money is completely safe. There's no risk of losing any of your money, up to quite high limits. So again, just worth considering. So I've talked a bit about debt and savings, two sides of a coin really. I wanted to talk a little bit now about why in financial services markets, in the financial services world, loyalty really doesn't pay. There is no reward for sticking with your current provider in the world of personal finances, whether it's savings, current account, insurance, whatever it may be. You might think, oh, well, I've got my bank account with this bank, so I might as well take out all my other products with them as well. It'd just be easier. Well, it might be easier, but it won't be financially savvy. And when it comes to things like insurance and other, broadband, things like that, you can actually save quite a lot of money by switching around. So definitely worth the small investment of time to shop around and switch to better products, because you will save money, whether it's a small amount or a large amount. So just to use a couple of examples, if we look at insurance, until recently, when your car or home insurance renewal policy came up for renewal, you would quite likely to get a bigger renewal charge than a new customer with exactly the same policy. And insurers, car and home insurers, have had to be banned by law from charging existing customers more than new customers for the same policy. They wouldn't do it out of kind of sense of doing the right thing for their customers. So in the end, the law has had to be changed. So now you should get the same quote when your car insurance comes up for renewal, your house insurance comes up for renewal. The quote you get for that policy should be the same as they're offering new customers. That said, your renewal quote is still unlikely to be the cheapest. And when it comes to car and home insurance, where you're spending quite a lot of money each year, potentially, you could save hundreds of pounds by not auto-renewing and spending a few minutes shopping around. It's quite easy to do this. You just need to go onto a comparison website, put in your details and look for the cheapest comparable deal. Obviously, you need to look for a policy that it's comparable to the one you're currently on, but it definitely makes sense to do it. Once you've got that quote, what we might call a benchmark quote, it's worth going to your current provider and trying to haggle, because they may decide that it's worth keeping your custom and offer you the same or possibly even a slightly lower premium. And if they don't, then it really isn't a big deal to change, but it's worth trying to haggle. On current accounts, so it is said that we are more likely to get divorced than we are to change our current account bank, which I think is a bit of a sad stat, because there's no reward for staying with your current account provider. There's quite a lot of new entrants to the market. There's quite a lot of app-based accounts. And there are also several banks that will actually pay you to switch your custom to them. So there are 4 banks who are currently paying up to £200 if you switch your current account to them, and that's Nationwide, HSBC, First Direct, and TSB. And there's no hassle to switching. You just tell your new bank that you want to move. You open the account, you tell your new bank you want to move, and they do it all for you. So you could be £200 better off just by switching current account. And certainly Nationwide and First Direct also do very well when it comes to customer service. They treat their customers very well, so they're a good bank to be with. If you're in credit, do look for an account that is paying interest or and or cashback on bills. So the Santander 123 account has pays interest if you're in credit and gives you cash back on your household bills. So you earn money just by paying your electricity and your council tax. So you get a few pounds back every month. And if you have an overdraft, look for a bank that's offering interest-free overdraft, or at least a cheap one. But several banks will offer £200 interest-free. So that's definitely worth having. Utilities, it's not a great time to try and switch energy provider. I think we've all seen the headlines, and we're probably all experiencing it, the fact that high bills are unavoidable. And at the moment, there aren't really any energy providers who are offering any good fixed rates, any fixed rate tariffs. But with all that said, there's still things you can do to reduce your, to minimise the amount you're paying and to reduce your bills, even if it's just by a small amount. I think this is a context where potentially every penny counts. So you've probably hopefully heard about the £400 energy grant announced by the government. This should be being paid automatically to you in 6 monthly payments. They started last month or the month before, of about £67 each. If you've not had a payment, then do contact your supplier. And similarly, if you're on a non-smart prepayment meter, you will have to apply to get the energy grant. Opt for paperless bills and online account management. That will reduce your bills by a small amount, maybe a few percent. And similarly, paying by direct debit is the cheapest way of running your account, and also make sure that you never miss a payment. Submit regular meter readings, which will mean you'll get accurate bills, so you're not paying estimated bills which might be higher than the amount you've used. And if your supplier does send you a high direct debit increase, do question it if it seems too high, particularly if you know what your usage is and it seems out of kilter with that, because they may reduce it if you can argue it with them. So and then moving on to broadband, this is another area where it's really worth switching if you're at the end of your contract or even out of contract. You could save hundreds of pounds by switching your broadband. And again, if you don't want to switch, try haggling. According to Martin Lewis, money saving expert that some of you might know about, broadband companies are easy to haggle with. It's a very competitive market out there, and they'll be keen to keep your customers. So again, find a cheaper deal and then go to your current supplier and see if they'll match it or even better it. Think about the speed. We all see the adverts for ultra fast, super fast fibre optic broadband, but do you actually need the fastest speed? Because it will also be the most expensive, and probably not all of us really need to be on those super fast speeds. So that could be one way of bringing down your bill. But if you are struggling to pay your bills, then do tell your provider as soon as possible, because they should try and help you out. Ofcom has told firms that they must do all they can to keep people's broadband running. So if you are struggling, get in touch. Hopefully they'll be able to put you on some sort of payment plan that means you can keep your broadband, but also not get into masses of debt. And if you're on certain benefits, then there's quite a few providers out there offering what are called social tariffs, which, according to which, you could be £250 a year better off if you are eligible. Estimates I've seen are that more than 4 million people are eligible for social tariffs, but actually only tens of thousands of people have applied for them. So there are a lot of people out there in receipt of certain benefits who could be on a much cheaper broadband deal and either don't know about it or are worried about switching to one because they're worried they'll get slower speeds, which has details of all the available social tariffs. If you go onto their website and search social tariffs, it should come up, and that will show you what's available, and you can check whether or not you're eligible. So I've talked a little bit about savings and where you can make savings by shopping around and switching financial products. I wanted just to talk a little bit about some financial products that it's probably worth avoiding or cancelling if you already have them. So the first of these is boiler cover, which is sort of insurance to cover you, which will pay out if your boiler breaks down. In reality, most people pay more over the years for the cover than they will ever pay out for repairs. So it really doesn't make financial sense. If you have a good boiler, or if your boiler breaks down, make sure you buy a good boiler. And if you have it serviced regularly, you really are unlikely to pay out very much in repairs. And if you are worried, you could always put a small amount aside each month. So you've got a pot there to pay for repairs. That will work out more cost effective, almost certainly, than paying for boiler cover. Along similar lines, extended warranties. Most products these days are reliable way beyond the period covered by extended warranties. So you'll be paying for cover that you never use. You also have protection from the Consumer Rights Act 2015, and this covers you for the first 6 years after you've bought something. And it means essentially that products must be of satisfactory quality. So if it breaks down within the first few years of ownership, then you have a right to go back to the retailer and ask them to sort it out, to repair it, and if it's not repairable, to refund it or replace it. The burden of proof after 6 months of ownership that it is a fault does lie with you, but that is not a big hurdle. And I've seen hundreds and hundreds of consumers come through Which's legal service and successfully pursue their retailers for refund of faulty goods. So that's definitely worth bearing in mind. The third one is car hire excess cover. So this is the cover you get offered. You turn up to pick up your hire car and they tell you your excess is £1,000. But if you pay them some eye-wateringly high premium, like £70, £80, they'll reduce it to a more reasonable amount. You can buy standalone cover for a fraction of the cost of what it costs to do this on a case-by-case basis. I mean, you can buy it just to cover a one-off trip, or you can buy an annual policy, which is even more cost-effective, and that will work out much cheaper. The only thing to be aware of is that if you do have an accident, you will have to pay the excess yourself and then reclaim it from the insurance. But financially, it makes much more sense than paying the prices charged by the car hire companies. And lastly, packaged bank accounts. So these are current accounts where you pay a monthly fee, and in exchange, as well as the current account, you get benefits. So you might get travel insurance, gadget insurance, breakdown cover. These are really only worthwhile if you use most or all of the benefits, which quite often people don't. So it's worth considering a standalone standard bank account and then looking at the benefits. So, you know, how much would the travel insurance cost if you bought it as a standalone policy? Compare that to the cost of the annual cost of the packaged account. You'll probably find you're better off buying the standalone policy. Also worth saying, if you have a packaged bank account and you've had it for a few years and you don't use any of the benefits and you feel like it was missold, lots of people have successfully claimed for missold packaged bank accounts. So that's worth thinking about, because you get if you were missold, you'll get the premiums back over a number of years. So I wanted to then now touch on, I guess, what I think of as kind of grown-up money, things like pensions and investments, which lots of people don't want to think about, particularly when it comes to pensions when they're young, because they think they don't need to, and which is true, you've got lots of time until you retire, but the sooner you start saving, the more you'll have. So starting with tax, which, you know, death and taxes, two things in life we can't avoid, but you can make sure that you're not paying too much tax and that you're taking advantage of any kind of allowances out there. So these are just a couple of things it's worth thinking about. So it's worth checking that you're on the right tax code. You could be paid too much tax, so it's definitely worth checking. And if you are, you can reclaim any tax that you've overpaid. If you're a non-taxpayer, if your income drops in a year, you might find you've overpaid tax. Your tax is worked out on the basis that you earn the same amount and pay the same amount of tax every month of the year. So if you stop working or your income drops, you've almost certainly paid too much. You can go onto HMRC's website. It's very straightforward to check your tax code and to reclaim overpaid tax. And I just thought I'd mention one allowance that people quite often aren't aware of and is quite useful and very easy to claim. So the marriage allowance, if you're married or in a civil partnership, and if one partner earns less than the personal allowance, which is £12,570 this year, then the lower earner can transfer up to 10% of their personal allowance to the higher earner, and that would save a couple up to £250 in tax. So again, very, very easy to do, and no reason not to, really. So pensions. If you are employed and your employer offers a pension, which most employers have to now, and they have to enrol you in it, so you actually have to actually tell them if you want to opt out. Opting out is basically like turning down free money. Pensions are very tax efficient, and your employer will pay into them as well. So if you do pay into a pension, your contributions can be taken from your gross pay, so that's your pay before tax is deducted, thereby reducing your taxable pay and the amount of tax you pay. So that's one way they're very tax efficient. Your employer will pay money in as well. So under auto enrolment rules, which came in a few years ago, contributions into your pension must be at least 8% of your salary, and of that your employer must pay in at least 3%. So if you opt out of your employer's pension, you're basically turning down free money. So if you can afford to pay into it, then it really does make sense to. And you will also get tax relief from the government. So for basic rate taxpayers, this is 20%. So if you want to pay in £100 into your pension, it will actually only cost you 80. The government will pay the other £20. So for all those reasons, it really makes sense to pay into your employer's pension if you can possibly afford to. And the sooner you start, the more you'll have when you come to retire. And then investments. It's a huge area. What do I mean by investments? I mean investing in stocks and shares, the stock market, unit trusts, investment trusts, bonds, anything other than cash, really. I would say that you definitely want to get the basics right first. You want to have sorted out your debts. You want to have your emergency savings in place before you start thinking about investing. And you have to understand that investing means taking risks with your money, that putting it in cash doesn't. But the flip side of that is that it comes with the potential for much higher returns. Over time, if we look back historically, investing in the stock market has returned much higher yields than investing in cash. But that comes with volatility. So it can be quite a bumpy ride. The trajectory might be up a line like that, but it's a bumpy ride along the way. So you need to be comfortable with that volatility and with the idea that you can lose money as well as make it. For that reason as well, you need to be okay to invest for the medium to long term, at least 5 years, and I would say probably closer to 10. So you need to be happy not to touch that money for that period of time. And this may sound obvious, but I have spoken to so many people over the years who didn't. You need to understand what you're investing in and the risks that you are taking, and to be comfortable with them. So many people I speak to just lost money and they didn't really understand what it was they were investing in the end. And under a kind of fundamental principle in investing is that you diversify. Don't put all your eggs into one basket. If you diversify across different types of investment, in different countries, in different asset classes, then if one tanks, the hope is that another one will hold its own or even go up. Whereas if it's all in one and it tanks, then you've lost the whole lot. So diversification is a kind of fundamental principle of investing. But it is complex, and I would say that you should consider taking financial advice unless you are very confident and have the time to do your own investing. It takes time to do your own investing, and financial advice, although it will cost money, is probably an investment worth making. The financial advisor knows their stuff. They can understand your attitude to risk, your capacity for risk, what your objectives are. And also, if something goes wrong and you've taken financial advice and they've misadvised you, you have some protections there. You can make a complaint and you can go to the Financial Ombudsman Service. And then this will bring me on to my last few slides where I'm going to talk a bit about scams, but beware of unregulated investment scams. And there's sometimes quite a grey area between those two things. What do I mean by unregulated investment? I mean things like wine, storage pods, funeral plots, gold. If you put money into those and you lose it, then you're unlikely to get it back. And sometimes these are sometimes they're scams, and sometimes they are just kind of dodgy, unregulated investments. But just be aware, and if you're unsure, then give it a wide berth. And so for my last few slides, I just wanted to talk a little bit about scams, because I think if we're talking about how to manage your money, then spotting and avoiding scams and understanding what to do if you have been scammed is, unfortunately, in this day and age, a crucial part of that puzzle. I think we all probably know scams are on the rise. UK Finance reckons that victims have lost more than £250,000 to scams so far this year, which I think is an astonishing sum of money. Citizens Advice warn that more than 3/4 of adults have been targeted by a scam this year, which is a 14% rise on the same time last year. That probably chimes with our own experience. We probably all receive one of those texts or emails or an unsolicited phone call that's probably a scam. So common scams that we see include things like phishing. So this is where scammers pretend to be from your bank. They might tell you that you've been a victim of fraud and you need to move the money to a safe place. They'll persuade you to give you their passcodes. They're very sophisticated. They can take quite a long time on the phone with you. And then ultimately you transfer money perhaps to something they say is a safe account, and obviously it's not a safe account, it's theirs, and the money's gone. Email or phishing scams, where somebody pretends to be from HMRC or from your broadband provider, and either ask you to pay money or to click on a link. Investment scams, I've touched on those. So unregulated can also be a scam. Also thinking about things like cloned websites. Scammers quite often clone the websites of legitimate investment companies. So if you see something that's offering a very high interest rate or something, it might be a scammed website. The FCA has a register of investment companies where you can check they're regulated. It also puts out regular alerts about investment company websites that are cloned. So it's worth checking if you're unsure about a website you've come across, or even ringing a company from a different number and checking whether it's actually legitimate. Fake delivery text, I'm sure we've all had a DPD, Hermes text, you've missed a delivery, or there's a feed you. Fake shopping websites, so these are where you get apparently very cheap goods, designer goods perhaps, where the goods even never arrive, or when they do arrive, they're very, very shoddy. HMRC calls text, so perhaps telling you you've been due a tax rebate, or I quite often get calls telling me that I haven't paid my tax bill, I'm about to be taken to court, I'm going to go to prison. And the last one on this list isn't actually a type of scam, really. It's how a lot of these scams are kind of enabled and paid for. So it's authorised push payment scams. So authorised push payment is where you authorise payment. So the scammer talks you into it, or you think you're paying for a legitimate item and you're not. So you do the bank transfer. And that's an increasingly common way that scams are kind of facilitated, and has particular kind of rules around how banks deal with them, which I'll come to in a minute. So how to spot and avoid scams. I mean, it's an old cliche, but if it looks too good to be true, then it probably is. If it's a really, really cheap item that's much cheaper than expected to be, it's a really surprisingly high interest rate, almost certainly a scam. So approach it with caution and do a lot of due diligence before you part with any money. Have you been contacted out of the blue? We tell people all the time, and it should be a life rule, never ever part with money off the back of a cold call. A legitimate company will not contact you and expect you to pay money. Are there spelling mistakes and typos in the email or text? Sometimes the English can be a little bit kind of stilted. That's usually a red flag. Have you been asked to share personal details? The links in text messages and emails quite often will take you through somewhere where you share your personal details. You might not be scammed immediately off the back of that, but they're harvesting your data, and they'll probably come back to you in a few weeks or months and use that information to scam you in another way. Have you been asked to keep something a secret, not tell anyone? Maybe we speak to people who've been scammed by people pretending to be the police. There's no reason why anyone, a legitimate person, would not want you to tell your friends and family, so that's a red flag. Or if you're feeling pressurized to make a decision, again, a legitimate company won't mind if you say you need to take a day, a couple of days to think about it. Whereas a scammer, and they might have been grooming you over several calls, will pressurize you. They won't want you to go away and talk to other people about it. They will want you to make a decision there and then. Don't click on links in text messages or emails. Which and other organisations are working with companies to try and persuade them legitimate companies not to put links into text messages and emails, because it's quite hard to tell legitimate messages from scam messages, but particularly if it's something you're not expecting, just don't click on the links, don't share any personal data. So don't share personal details or ever passwords or passcodes. Your bank will never ask you for a passcode in full. And don't pay by bank transfer. So if you're paying for a holiday villa, paying for some shoes, stay on the platform. Some scammers might ask you to come off platform, and they'll have a very good reason why they need you to pay by bank transfer. If you do that, you may well struggle to get your money back, and it's almost certainly a scam. And then just lastly, what to do if you've been a victim. I mean, if you have been a victim, it really is nothing to be ashamed of. So many people, the scammers are so sophisticated and they work so hard, and they're very, very good at what they do. But if you have been a victim of a scam, then contact your bank immediately, your bank's fraud department, or there's a number 159 that some banks have signed up to, which will put you straight through to your bank's fraud department. And then getting your money back will just depend on how you paid. So if it was a credit card, you might be able to use Section 75, which I referred to earlier. If it's a debit card, there's a similar scheme. It's voluntary, it's not written into law, but it's a pretty good scheme called chargeback. So again, you could try asking your bank to do a chargeback. There are time limits on chargeback, so if you should get your skates on with that. There aren't with Section 75, there are with chargeback. Or did you pay by bank transfer? Was it an APP scam? So there is a voluntary APP scams code that most of the major banks have signed up to. Sets out various rules around their expectations on how customers should behave and on how they should treat scam victims. But the long and the short of it is they should reimburse victims who are considered to be not to blame for the scam, for the victim to the scam. In reality, when I was at Which, we saw a lot of banks either not reimbursing when we thought they should, or only reimbursing 50% because they said the consumer was 50% to blame. If they don't reimburse you, then you should make a complaint. Was it an unauthorized payment? So this is where the scammer took the money without you knowing about it and without your consent, not where you didn't make the payment, where they took it. If it was an unauthorized payment, the rules are quite different. They're written into the banking kind of laws, and the bank should reimburse you unless it can prove you were negligent, and that's quite a high legal bar for them to get over. So 99% of the time they should reimburse you, and if they don't, you should complain. And if you do complain and the bank still doesn't uphold, still doesn't reimburse you, you can go to the Financial Ombudsman Service. The Financial Ombudsman Service is free to consumers. They will look at your evidence, they'll look at the bank's evidence, and they will decide who's in the right and if they agree with you, they will compel the bank to refund you. And lastly, you should report it to Action Fraud. They probably won't investigate it, and they have been quite criticised for the lack of investigation, but it does mean they do at least know what's going on in terms of scams, and they can build up a picture nationally of what scammers are up to, because scammers do change their tactics quite quickly, so it's quite useful. So that's everything I want to touch on. I hope that you found some of it useful. I mean, I would just say in conclusion that managing your money isn't rocket science and can be quite fun. If you go to, some people really set themselves challenges. How much money can I save this month, this year, by shopping around, and they become kind of super savers. And if you go to Money Saving Expert, you'll see lots of forums on there of people who kind of almost make a competition out of saving money, and you know, it's something they really enjoy doing. Get organised, and get the basics right, and I think the rest will fall into place. You know, fundamentally, you need to understand how much money you've got, how much money you can spend each month, and if you have some left over, what you're going to do with it. And don't rush it. There's a lot here, so take it one step at a time. It will all start to fall into place. And there is a lot of information out there, which can help and which is quite useful. So the websites I suggest are Money Saving Expert. That's Martin Lewis's website. He has a lot of guidance on there. He also has a lot of kind of very up-to-date thing about kind of cashback and coupons and ways that you can save on shopping and things. Which Money, I mean, I'm biased, I used to work for them, but there's a lot of stuff on there. And Money and Pension Service. All of these websites have lots of information and guidance, and they also have lots of tools that can help you, and are quite fun, and calculators that you can use to kind of help you decision make and to know, to set objectives and all those sorts of things. So I hope that's been slightly useful to some people. If anyone's got any questions, I think we can come on to those.
Great. Thank you so much, Rebecca. That was extremely insightful and super helpful. And I'm sure everyone would agree with me. We're going to take the last 30 minutes for the questions now. We've got many actually, so let's kick off with them. The first one is from Martin. What life ISA provider would you recommend, like Nutmeg or Honeybee? And following the same lines, there was another question from Pamela. Is it worth changing a help to buy ISA into a life ISA?
I don't know, I'll be honest, about which LISA provider I would recommend. I'm not close enough to the market at the moment. There will be lots of websites. If you go onto Martin Lewis or Which, I suspect they have recommended providers and best buys in terms of lifetime ISA providers. And so it'd be worth checking out. I have to confess, I'm not close enough to the kind of the specifics of the market to know which one, and because it changes quite quickly. I would say that Nutmeg and Honey, certainly Nutmeg is around investment rather than cash, mostly, I would have thought. So probably that's one where you maybe want to be happy with a level of risk, but I don't actually know because I'm not close enough to the market. And the other question was around Help to Buy and lifetime ISAs.
Yes.
Was it? Sorry, I didn't.
So is it worth changing a help to buy ISA into a life ISA?
Again, I'm not 100% sure on that one. I didn't look at Help to Buy ISAs for this particular talk. Just bear with me. So I wouldn't actually know. You do generally have to be quite careful switching between different types of ISA because there will be rules around how you do that and whether or not you lose bonuses. But it's certainly worth looking into, and I'm just checking. I suspect there is guidance on this on the Which website, probably on Martin Lewis as well. Sorry, my internet's gone a bit slow. Are you still there?
Yes.
Yeah, sorry. Sorry, my internet's been a bit glitchy. Bear with me. Are there any other questions while I'm looking at this one?
Right. The next question is from Andrew, which is, how do we know which bank is best to be with? So he thinks HSBC seems more international. So any other recommendations from you, Rebecca?
Well, again, it depends what you're looking for. So there are certain banks that traditionally do very well when it comes to kind of customer service, and actually HSBC wouldn't be one of those. As I think I said in the talk, First Direct traditionally does very well when it comes to customer service, as does Nationwide Building Society. In terms of, but it depends what you're looking for. So some will be better if you run your account in credit, and some will be better if you run your account in overdraft. but HSBC traditionally has not been one of the best when it comes to customer service. But again, it does depend a bit what you're looking for. But in terms of customer service, First Direct and Nationwide traditionally do very well. Some of the big four banks, so that's HSBC, Barclays, Lloyds, and NatWest, traditionally don't do that well when it comes to customer service. And that's one of the things about switching. A lot of people opened their students' accounts with the big banks when they were students and just stick with them for the rest of their lives. And actually, they'd be much better off switching because they get better service if they went elsewhere. Does that make sense?
Great, thank you very much. We've got another question from Sophia, which is around the credit card. So, how could someone get a credit card easier, as it's quite difficult to get one due to having no credit score?
So, as I said in the talk, there are some credit cards out there that are specifically aimed at people who've never had a credit card before and want to build their credit limit. Off the top of my head, I don't know the names of any of them, but I know, again, if you go onto Which or Martin Lewis, they have specific kind of tools that help you compare them. You will pay a higher interest rate, so it's worth trying to pay, not to spend too much. You'll have a lower credit limit, so you probably only have a credit limit of a few £100s, and you have a higher interest rate. But they're specifically designed to build your credit limit. So long as your credit score, sorry. So long as you repay it fairly diligently every month and don't miss any payments, then they will help you build your credit score. And they're specifically designed for people who don't have a very good credit score but want to build their credit. So just if you go onto it, Martin Lewis or Which have got credit card kind of comparison tools. I don't have all of the kind of market data in my head, I'm afraid, but if they have comparison tools, and it includes credit building credit cards.
Great, thank you. Another question from Chelsea is, are online banks trustworthy?
Yeah, there's no reason to trust them any less than any other banks. Which does a regular survey or kind of investigation into the security measures, the kind of safety of online banks and the online offers of all of the sort of traditional banks, if you like. And all of them have have a basic level of security. Some are better than others, but there's none to avoid. And the online banks, they all have to have the same. So from an IT point of view, they all have good security, and they will all, from a kind of security of your money point of view, they all have to pass the same tests for the regulator in terms of having enough money there to make sure they're not going to go out of business, and having good business models and all those sorts of things. So there's no more risk to your money, either from a kind of IT perspective or a going out of business perspective from the online banks. And some of the new app-based banks like Monzo and Starling, they do very well in kind of the comparisons with some of the newer, bigger banks. So they're definitely worth considering. And there's no reason from a kind of security or safety point of view not to.
Great, thank you. Next question from Brooklyn is, do you believe that it is important for international students to establish credit in the UK if they're staying for a period of over 3 years?
So when you say establish credit, do you mean establish a good credit history so you can get credit? I mean, I would say if you're going to stay in the UK for a period of time and you think you might want to borrow money, or indeed take out a contract for something like a mobile phone where you will be credit scored, or if you want, or even insurance, for example, if you want to pay that on a monthly basis, most of those involve basically paying interest, so they will credit score you. Anything that involves potentially somebody checking your kind of lendability, yes, in that case, it's definitely worth trying to build up a credit record, a good credit history, if you think you might want to borrow money or undertake something that involves somebody checking your credit score. So that involves very basic things like getting on the electoral register, but also then trying to take out small amounts of credit and managing it well, essentially. But yes, I would say if you're planning on having a financial life here for any length of time, it probably makes sense to build up a good credit score.
Great, thank you. The next question is from Maria, which is, do you think share to buy is a good option for people who don't have a high enough salary to be lent enough to buy their first property?
Now, shared ownership is not a huge area of expertise of mine, so this is very much kind of my personal opinion rather than based on any particular research I've done into it. I think it can be, but I think you need to think quite carefully about it. I mean, whether or not you're ever going to be able to increase the proportion you own, I don't. I think there are probably drawbacks to it in terms of getting you onto the property ladder. I don't know how easy it is to sell on shared ownership property. So once you've got into one, I don't know whether there are issues with selling them on, whether you have to sell them back to the housing association or whether there is a market out there for people to buy your. So whether you get a bit stuck with them, that might be my slight worry, and that there might be quite onerous terms around how you increase the amount you own and kind of upkeep on the property and that sort of thing. But I have to confess it's not a big area of mine, but I know that I think I would probably approach it slightly warily, as I don't know how easy it is to progress from owning a proportion in a shared ownership house to actually owning a whole house, if you see what I mean.
Right, thank you. The next question from Martin is, when do you think the economy will bounce back from the living crisis or recession in terms of years?
Um, when I worked on the money helpline, one of my advisors always used to say to people who asked him questions like that, I left my crystal ball at home. Um, I, if I knew the answer to that question, I would be a very rich person, or I'd be about to be a very rich person. I think it's impossible to say. I mean, in terms of inflation, I think there are predictions that it will continue to go up a bit for the next couple of months, and then probably this time next year it will have started to come down again to levels more like sort of 7%. And I guess that would be a good sign in terms of things starting to pick up a bit in the economy. But yeah, I'm afraid I'm going to hold my hands up and say I really don't know the answer to that. I would be a very rich person if I did.
Right, that's fair. So the next one is from Muhammad, and he's looking to gain more confidence in money management with a small budget. So he feels that money can quickly feel like the enemy when it's actually not. So, do you have any advice on starting to get control over a small budget or being able to save money each week within a small budget?
I mean, I think it is a case of self-discipline. So set yourself. I mean, I go right back to the first slide, and I would say look at your monthly or weekly expenditure and income, and understand how much you have left at the end of each week or each month, and decide what you want to do with it, and then open a savings account and start paying money into it. Set yourself a goal, and and uh, and just start paying money into a savings account towards that goal, and you'll quickly see things starting to build up. But I would probably commit. I would say I want to save £20 a week. I want to save £30 a week, and try and stick to that, even if it means you have to sort of pull back on the number of times you go out. Or I'm not going to go out tonight because I know if I do that, I won't be able to put the amount away this week that I've been saying. Um, and be realistic. I mean, have a look at how much you've got and set yourself a realistic goal within that, and then work slowly towards that. And I would say it's also do take a look at where you can make savings, because even kind of small changes can make a difference, even if it's a small difference to how much money you have in your pocket. Even if you switching to a slightly higher paying interest account, switching to a current account that pays you interest if you tend to run it in credit, looking at where you're spending money on things like insurance and things like that, and can you save any money there, even if it is just a small amount, and maybe commit to, if you make a saving and you can afford to, then put that bit of money aside. Say, okay, I've saved £50 this year on my house insurance, my car insurance, so I'm going to put that £50 to one side and save it. just try and build up your pot like that. And I
That's
suppose the
very
other thing to say is there's quite a lot of apps out there. Sorry, there's also quite a lot of apps and tools out there that can help you. So that can kind of make it more interesting, and depending on the sort of person you are. So there's I was talking to somebody today actually who's been using something, I think it's called Money Hub, and that pulls all of your accounts together and has tools in it and it's free for the first 6 months, I think, and then it's about £15 a year, but it's free for the first 6 months, and it aggregates all of your accounts and everything you've got together, and so you can see, what you're spending your money on and what sort of thing, and you can play around then with your money, and you can maybe make a bit of a game out of it almost, so you can really keep on top of what you've got and see everything in one place. There's a lot of tools out there as well. It's worth looking around, seeing what's available in terms of helping you kind of visualize how much money you've got and what you're spending it on.
great. Thank you. The next one is from Andrew, and he's asking if there are any good ways of earning money while still studying that aren't major commitments. So, for example, he works in a TV or film extra occasionally, and the extra money always helps. So, do you have any suggestions around those lines?
That is not an area I'm a massive expert in. I would say there are things like you can get paid to complete surveys. It's not very much, but some places will pay you to kind of sign up. So like YouGov, I mean, it's really not very much, but you can sign up to take regular surveys with them, to take part in research. I guess you could sign up for, within reason, medical and scientific trials that can get you some money, but don't take any unnecessary risks of your health. But there are places that will pay you to take part in trials. This is just really off the top of my head, things that I can think of. Yeah, that one I'm struggling with a bit, to be honest. Not an area of particular expertise, but there are bits and pieces like that, I think, that don't take amount of commitment, but that you can just do sitting in front of the telly. So surveys and stuff you can just do sitting in front of the telly. Or, I mean, things like being a mystery shopper. So phoning, again, signing up with research companies, and they'll pay you to phone around and pretend to be buying stuff and that. And that, again, doesn't take a huge amount of commitment, and you can do when you're available.
Right, thank you. And I see Maria and Holly have added something in the chat so people can use them as well. Thank you so much, guys. The next question is from Chelsea. How long does it take students to build up a good credit score?
Oh gosh, I mean, that's slightly how long is a piece of string, I think. Probably depends a bit what you do, and how you do it. As I say, the basics are things like getting onto the electoral roll, and so I'm sure you know this, but your student loan doesn't appear on your credit report, so you don't need to worry about your student loan, but manage other financial commitments you have sensibly. If you can take out a small credit card, but pay it off, don't build up debt, that will help. If you can demonstrate that you can manage financial commitments sensibly, that will help. The longer although I'm advising you to switch, don't switch a lot within a short space of time, and don't take out lots and lots of credit cards in a short space of time, because that will show as hard credit searches, and if you have a lot of credit searches on your report in a short space of time, that kind of reduces your score. So only take out a credit card once every 6 months or a year. Don't apply for lots at the same time. Once you do have a credit card, manage it sensibly, keep within your overdraft limit. Make sure you make mobile phone payments. Try not to miss payment. If you keep up with all of your financial commitments, because any missed payments will be a black mark on your credit report, and they'll lower your score. I think it's really hard to say how long it takes. I would say a year or two, but so long as you have a credit presence, and you have a credit file, you'll probably find there will be somebody who will lend to you. It's just the better your credit score gets, the more options you have in terms of people who will lend to you, and therefore getting better rates and stuff like that. So the longer you kind of can stay on top, the more you can stay on top of your credit, your commitments, and make all your repayments, then the better, really.
Great, thank you. The next question from Hanya is, what is the best way to keep a consistent good credit history?
Sorry, say that again.
What is the best way to keep a consistent good credit history?
Well, it's all the things I've said, really, in terms of not applying for too many items of credit at the same in a short space of time, because that will, if you actually apply, you can check out your eligibility, and the lender will do what's called a soft search, and that won't have an impact on your credit file. But if you actually apply for lots of different forms of credit in a short space of time, they will all show as hard searches, and lenders don't like to see a lot of hard searches in a short space of time, because it shows you're potentially applying for too much credit, and they just don't like to see it. So don't apply for lots of different forms of credit in a short space of time. Keep on top of your repayments, keep on top of your bills, because that will it's not only that they show missed payments, your credit report shows that you're maintaining a good record of repayment on all of your commitments. So there's a kind of positive effect. It's not just a negative effect of missed payments being a black mark. There's a positive effect of building up a record of consistently repaying debts. Do have some credit on there, say be on the electoral roll. And I would also say keep an eye on your credit file, because you can you can access them for free mostly now. There are three credit reference agencies, and I can only ever remember the name of two. And there's Credit Karma, and there's Experian, and there's another one which might come to me before the end of this session. Go on to those websites and check your credit file periodically. Check there's nothing on there that shouldn't be on there, and check that everything that you expect to be on there is on there, so that you are on top of it and you know what is there. But essentially, the best way of maintaining a good credit file is just to meet all of your monthly commitments and not miss payments, and to have some credit, so you can demonstrate your ability to borrow responsibly, I guess.
Thank you. The next question is, do you know if pay later services like Klarna have an impact on your credit score?
If you missed, I believe I'm right in saying, although I might just double check this, I was just thinking, as I said it, I think probably they do. I think if you miss payments on Klarna or any of those, then that would go onto your credit file. Although they don't check your credit report, they don't do any affordability checks, I think missed payments probably would reflect. I am just going to check that, though, if you just bear with me. Ask me another question while I'm checking it, but I'm going to... I suspect it will, though. I'd be very surprised if they didn't.
Right. Meanwhile, another question is, how do you know what to invest in, and if you're investing in is worth the risk?
So this is where I would say, ultimately, a financial advisor is a good idea, but only you can really know whether it's worth the risk. You can assess how risky something is. You should... an investment, there should be information on the investment to give you a sense of how risky it is. There are some obvious things. Investing in China is probably more risky than investing in the FTSE 100 in the UK. So there are some kind of common sense things, but funds will have a risk rating, so you can assess how risky they are, and then you need to ask yourself how much risk you're comfortable with. You know, the general assumption is the riskier an investment is, then the greater the potential for a high return, but equally, the greater the possibility that you will lose everything, that you will take a big dip. So I think you have to ask yourself the question of how much appetite do you have for risk? Are you comfortable with the... You know, it fundamentally comes down to the question of, are you comfortable with the idea that your investment could lose all of its value overnight. And if you're not, then you're probably not ready for a very high risk investment. But it's also about capacity for loss. You know, it doesn't really never invest everything you have in a high, no matter what your appetite for risk. It probably doesn't make sense to invest everything you have in a super high risky investment, because then if it's everything you've got and you lose it, then it's all gone. So what's your capacity for risk? Can you afford to lose what you're investing? Because that is a risk with very high risk investments. And this is where a financial advisor, and there are kind of online investment advisors now, which are much cheaper, but they will do a risk questionnaire. They will take you through and try to assess your appetite for risk, and they will grade that, and then they will suggest investments that match your appetite for risk. Trying to do it on your own is, it's quite a big investment of time, and it's also quite complicated, and you have to make sure, I think you have to be sure that you understand that you understand what it is you're doing before you undertake that on your own. A financial advisor will cost a bit of money, but I would say it's an investment worth making. I wouldn't make my own investment decisions. I would see in a financial advisor, because that's what they do, that's what they're paid to do, and that's what they're expert at. But yeah, I mean, if you do it yourself, you do have to ask yourself, you have to give yourself some questions about what your attitude to risk is and your appetite for it, and then try and find some investments that match that.
Great, thank you. The next question is, do you have a recommendation on which bank to open up a credit card with?
Well, again, I mean, I could spend some time going through some comparison tables online, but really you can easily do that yourself. It depends what it is you're looking for. There's not a bank that is really good for credit cards. There are lots of banks, and they have lots of different credit cards that are good for some things, are good for some things, and some things are good for others. Some banks will offer really good 0% purchase deals. Another bank might offer a card that you can use for free abroad. It really depends what it is you're going to want to use the credit card for. That will give you the best credit card. Actually, I don't think Which does have comparison tables at the moment, but Martin Lewis has lots and lots of different tables depending on what you're looking for a credit card for. So yeah, there's not one answer to that really. It completely depends. So think about what you want to use the credit card for. If you want to use it for purchasing, then think about a 0% purchase credit card, but do make sure that you know when the 0% deal is going to come to an end, and ideally you would make repayments over that period so that you can pay off the balance by the time the 0% period comes to an end. Do you want to transfer a balance? Again, look around for the best 0% deal, the longest one with the lowest fees. Most of them charge a small fee for transferring a balance, like 2 or 3%. So look for the longest deal with the smallest fee. And also, it is a changing market, so a good deal today might not still be around tomorrow. So yeah, just think about what you want to use it for. If you want to use it to spend abroad, again, there are some cards out there that are free when you use them abroad. I have a Santander, I don't know if it still is, but I took out a Santander one because I knew it wouldn't charge me when I went abroad. A couple of things to be aware of with credit cards that I didn't mention. If you don't use them for cash withdrawals, if you can avoid it, because you'll get charged interest immediately, and it's not a cost-effective way of getting cash out. But yeah, go and have a look on Martin Lewis and have a look at his comparison tables. I would think about what you want to use it for, and then have a look on Money Saving Expert, and you'll find the best credit card.
Thank you. Another question from Sophia is, what regulated investments would you recommend someone to invest in, especially as a beginner?
I can hold my hand up and tell you I can't answer that, because that is regulated activity. I can't advise on investments because I'm not a financial advisor, and in order to recommend investments, you would need to speak to a regulated financial advisor at that. So the Financial Conduct Authority regulates certain financial activities, and one of those is investments. You can go out and choose an investment yourself, but in order for somebody a financial advisor to recommend them. Someone, I would have to be a regulated financial advisor, and I'm not. And I also am not sufficiently familiar with the the investments market, and I don't know anything. This goes back to what I was saying about financial advice. Even if I was a regulated financial advisor and I was really, really familiar with the regulated investment market, I couldn't answer that question because I don't know what the person who asked it wants to achieve. I don't know what their objectives are. I don't know what he wants to achieve with investment. I don't know what his attitude to risk is. I don't know how much money he has. These are all questions that you need to have answers to before you know what you can invest in. Now, there's a lot of platforms out there. There's Hargreaves Lansdown, there's Vanguard that you can go to and choose your own investments. But if you want a recommendation, you would have to go to a financial advisor. As I say, there are online ones, which are quite good and much cheaper than an in-person. But you would, to get a recommendation on a regulated investment, you'd have to speak to a financial advisor. But that brings with it protections. You know, then if the financial advisor misadvises you and sells you something inappropriate, then you can make a complaint.
Great, thank you. The next question is, what is your personal opinion of premium bond investments?
I think they're good for some people. They're not going to set the world on fire. You know, their equivalent interest rate is not super high, and it can't be because they're government backed. The government can't be seen to kind of be competing too aggressively with commercial savings providers. So they're not going to set the world on fire, but they are very, very safe because they are government backed. So you don't. So with most, with other savings providers, you're up to £85,000 is protected, and if your provider goes bust, you can go to the Financial Services Compensation Scheme and get it back. With National Savings Investments, you don't have to worry about that. I think the maximum deposit is £1 million. I might be a bit out of touch with that, but it's got a very high maximum deposit, and it's all protected because it's government backed. So you don't have to worry about National Savings Investments going bust. So it's super safe. You might win the big prize. So there's always that kind of element of, I guess, excitement. Am I going to win the big prize? You probably won't, but you might do. But yeah, I mean, a lot of people love their premium bonds. I have to say it tends to be older savers who like them because they like the certainty. They like knowing their money's very safe. But yeah, that they serve a purpose, but you're not going to get the best, unlikely, unless you do win the big prize, to get the best return on your money from premium bonds. But you know, you will get some return, almost certainly.
Great, thank you. And we have the last question now. So can you use a credit card when you travel abroad? How good or bad is it?
Yes, you can use a credit card when you travel abroad. I go back to what I said earlier. There are some credit cards that are better than others because generally when you go abroad and you use a card, be it a credit card or a debit card, you will get charged a fee for using it. You'll get charged an exchange rate loading fee, and you might also get charged a transaction fee. So the thing to look for if you want to use a credit card abroad is one that is free or cheap to use abroad. But yes, absolutely no reason not to use a credit card if you can find one that isn't going to charge you for it, and you then have the advantage that if you buy something that costs over £100 and less than £30,000, you get your Section 75 protection because that applies to foreign transactions. I would say don't use it to get out cash, even abroad, because you will get charged. With a credit card, you usually get a period of interest free, so the first 56-ish days are interest free before you start getting charged any interest, at least if you clear your balance every month. But on cash withdrawals, you get charged from the moment you take the cash out. So and you usually get charged a fee, even if it's free abroad, you'll get charged for taking cash out. But yeah, credit card's a perfectly good way of spending abroad, but just look for one that's not going to charge you.
Great, thank you very much. And I think that's all we had time for. Thank you to Rebecca for your insights today. They have been incredibly helpful. So thank you once again. And thank you to everyone who joined in today. Thank you so much for your time. The highlights from this event will be on the Alumni YouTube channel in the next few weeks. And please do complete the short evaluation survey, which is in the chat box now. That was the last What It Take event of this semester, and more information of future events and booking details can be found on What It Take pages of the university website from early 2023. Once again, thank you so much to everyone for joining in today, and especially Rebecca, because you've been incredibly helpful for everyone. And we hope to see you sometime in future again. Thank you so much for today.
My pleasure. Thank you very much for inviting me.
Thank you. Have a lovely evening ahead. Thank you, everyone. Take care. Bye.
Bye bye.